If you had $100,000 sitting in your bank account right now, what would you actually do with it? Most people imagine that amount of money as life-changing. But here is the uncomfortable truth. A large lump sum without a clear strategy can disappear just as quickly as it arrived. The problem is not the money. The problem is the lack of structure. And when it comes to investing a significant amount like $100,000, the decisions you make in the first year often matter more than the next 10. So before we go deeper, take a moment to like this video, subscribe to the channel, and comment long-term below if you believe investing should be about discipline, not drama. Because today we're going to talk about what really happens if you invest $100,000 into 5 strong, diversified ETFs. And more importantly, why structure matters more than excitement. The first mindset shift you need to make is this. $100,000 is not a lottery ticket. It is a foundation. Many beginners see 6 figures and immediately think about maximizing returns. They start asking which ETF will grow the fastest, which sector will outperform, which region will explode. But here's what most people misunderstand. The goal with a large lump sum is not to chase performance. It is to build a durable system that compounds steadily over decades. When we talk about investing in 5 strong ETFs, what we're really talking about is diversification with purpose. Exchange-traded funds allow you to own a basket of assets rather than relying on a single company. Instead of betting on one stock, you're participating in entire markets, sectors, or asset classes. That reduces single-point risk. If one company fails, it barely affects the overall structure. If one sector struggles, others may offset it. Diversification does not eliminate risk, but it spreads it intelligently. Now pay attention to this part carefully. The magic is not in the number 5, it's in the balance. A thoughtful ETF portfolio might include broad market exposure, international diversification, perhaps some bond allocation for stability, and maybe targeted exposure to specific areas like small-cap companies or emerging markets. The exact mix depends on your risk tolerance and time horizon. But the principle remains constant. Build a structure that can survive volatility. Let's talk about what actually happens when you invest $100,000 into diversified ETFs and leave it alone. In the first year, not much may happen. Markets fluctuate. You might see gains. You might see losses. And this is where beginners go wrong. They expect immediate visible growth because the starting amount feels large. But investing is not about short-term visibility. It's about long-term compounding. Here's what most people underestimate. Compounding works best on large bases over long periods. A $100,000 investment growing at a steady average rate over 20 or 30 years can multiply significantly, even without extraordinary performance. The key is time. The key is reinvesting dividends. The key is staying invested during downturns. Interruptions are the real enemy of growth. Now let's address a common emotional mistake. When someone invests a lump sum, they often become hyper-aware of market movements. A 2% drop suddenly feels like thousands of dollars lost. That emotional intensity can push people to sell prematurely. But volatility is normal. A diversified ETF portfolio will experience declines at times. The disciplined investor understands that short-term fluctuations are part of long-term progress. This is where emotional discipline becomes central. If you invest $100,000 with a 5-year mindset, you will likely feel anxious. If you invest it with a 20-year mindset, short-term drops become less threatening. Perspective changes behavior, and behavior determines results more than strategy alone. Now pay attention to this part. Investing a lump sum does not mean abandoning risk management. Some investors choose to invest all at once. Others prefer to phase the money in gradually over several months to reduce emotional stress. There is no universally perfect method, but the decision should be based on discipline, not fear. What matters most is that once invested, the money remains aligned with a long-term plan. Let's break down common mistakes people make with a $100,000 investment. One mistake is concentrating too heavily in one theme or sector because it has recently performed well. Another mistake is constantly adjusting allocations based on news headlines. A third mistake is ignoring costs. Even small expense ratios can compound over decades. Low-cost ETFs preserve more of your returns. Here's what most people misunderstand about diversification. It may feel slower, but it is safer. A concentrated bet can create dramatic gains, but it can also create dramatic losses. A diversified portfolio grows more steadily. It prioritizes survival over excitement. And survival is what allows compounding to work. There is also the psychological shift that happens when you cross into six-figure investing. You start thinking differently. You become more focused on preservation and sustainable growth rather than speculation. That shift is healthy. Wealth building is not about taking unnecessary risks. It is about managing risk intelligently. Now let's go deeper, because this is where the long-term impact becomes clear. When you invest $100,000 into a diversified ETF portfolio and reinvest all dividends, you are essentially creating a self-reinforcing growth engine. Dividends buy more shares. More shares generate more dividends. Over time, that cycle accelerates. In the early years, the increase may feel small, but after a decade, the snowball becomes noticeable. After 2 decades, it becomes powerful. And after 3 decades, it can become transformative. Here's what most beginners don't fully appreciate. The first $100,000 is often the hardest. Not just financially, but psychologically. Reaching that level requires discipline. But once invested properly, it becomes easier to grow the next $100,000 because the base is larger. Returns start generating returns. The system gains momentum. Now pay attention to this part carefully. Risk tolerance matters. If you panic during a 20% market decline and sell, your strategy is too aggressive for your personality. The best portfolio is not the one with the highest theoretical return. It is the one you can stick with during downturns. That may mean including some bond exposure or maintaining a slightly more conservative allocation. Discipline always beats aggression over time. Another important layer is rebalancing. Over time, some ETFs in your portfolio will grow faster than others. This shifts your allocation. Rebalancing once or twice a year brings your portfolio back to its intended structure. It forces you to trim areas that have grown too large and add to areas that have underperformed. In a way, rebalancing builds discipline directly into your system. Taxes also play a role. Holding ETFs long-term often allows gains to compound more efficiently compared to frequent trading. Avoiding unnecessary buying and selling reduces transaction costs and tax friction. This is why long-term investors often outperform more active participants, not because they predict better, but because they interfere less. Here's where beginners go wrong again. They underestimate the emotional test of volatility. When headlines predict recessions or crises, fear rises. When markets rally sharply, greed increases. If you treat your $100,000 as fragile money that must never decline, you will constantly feel anxious. But if you treat it as long-term capital designed to ride through economic cycles, your perspective changes. You begin thinking in decades. The goal of investing $100,000 into 5 strong ETFs is not to double it in 2 years. It is to create durable, resilient growth over a lifetime. Over time, that capital can support retirement, supplement income, or provide financial flexibility. The transformation is gradual, but the direction is powerful. So let's recap clearly and calmly. Investing $100,000 into 5 diversified ETFs builds structure, not excitement. Diversification reduces single-point risk. Compounding amplifies growth over time. Reinvested dividends accelerate momentum. Rebalancing maintains alignment. Emotional discipline protects your progress. Costs and taxes matter. And patience multiplies outcomes. The real question is not whether 5 ETFs are enough. The real question is whether you are willing to stay consistent long enough for the system to work. If this deeper explanation helped you understand how to think about investing a large lump sum responsibly, like the video, subscribe to the channel, and comment disciplined growth below. And if you want to strengthen your long-term mindset even further, watch the video titled How $100 a Month Can Make You a Millionaire. Because once you truly understand compounding, you stop focusing on short-term fluctuations and start building lasting financial strength.